Hi, it's Neil here, back again. Welcome back. Chapter 8. This is the Dopich and Pereira textbook, one of the best on international accounting. Why? Because it's dated 2015 and now it's 2015. It's always good to have a textbook that matches the date in which you're studying a subject, even though they may be a few years late, but better than nothing. Okay, so we've got international accounting and we're looking at Chapter 8, translation of foreign currency and financial statements. Woo, let's get into the good stuff, shall we? Remember last week we looked at hedge accounting, and that was all about accounting for forward currency agreements, forward rate agreements, or for options. And now this week we're more interested in financial statements that are in a foreign currency, and there are different methods. We're going to look at those different methods. We're going to find out what are the principles of the GAAP and IFRS with respect to which of these methods are used. So here are some of the topics we're going to cover in this chapter. The conceptual issues of foreign currency financial statements translation, the difference between balance sheet exposure and transaction exposure, the methods of financial statement translation, and temporal and current rate methods illustrated. And I'm going to give you my idea about how best to remember the difference between those two methods, and the US GAAP, IFRS, and other standards related to translation. Finally, we're going to look at hedging of balance sheet exposure, but basically we covered that last week, so that will basically finish us up with this chapter. So the learning objectives are as follows. We want to describe the conceptual issues involved in translating foreign currency financial statements. We want to explain the balance sheet exposure and how it differs from transaction exposure. We want to describe the concepts underlying the current rate and the temporal methods of translation. And we want to apply the current rate and temporal methods of translation. In other words, you need to be able to do the calculations for the current rate and the calculations under the temporal method of translation. And describe the requirements applicable to IFRS, Generally Accepted Accounting Standards. And we want to discuss the hedging and balance sheet exposure. There are two conceptual issues here. The appropriate exchange rate. What is the appropriate exchange rate to be used in translating each financial statement item? As you get into it, we could use a historical rate. We could use the current rate. We can use the average rate. We can use the average of the last quarter rate. There are many different types of rates we can take out of the foreign rate system to apply to our financial statement. So which rate do you use? We're going to have a look at that. The other one, how should the translation adjustment that inherently arises from the translation process be reflected in the consolidated financial statements? So this is really interesting. How do you reflect it in financial statements? We're going to look at how it's done under the current rate method and the temporal method. So what do we mean by balance sheet exposure? Assets and liabilities are translated at current exchange rate are exposed to the risk of a translation adjustment. So therefore, when a foreign currency appreciates, a net asset exposure results in a positive translation adjustment. So, for example, if you're a US company and you have a subsidiary in China and the yuan appreciates, guess what? You're going to have a positive translation exposure. But if you have net liabilities in that subsidiary, so you've borrowed more than what the assets are in that subsidiary, then a foreign currency rate adjustment that is appreciating in the yuan, if the yuan appreciates, then you're going to have a negative translation adjustment. And that's the thing you want to think about, okay? So if you've got an asset exposure or you've got a net liability exposure. So just keep those things in mind. Very interesting as we keep going. There are different translation methods in the Dopich and Pereira textbook, Chapter 8. They talk about 4 methods, but really there's only 2. Here are 2 methods here. I've got a big no-no on this, so let's pass over this, shall we? There's a monetary, non-monetary method. We'll pass over that. This is the one we want to look at, temporal method. Why? It's the most popular method, and I'll explain why in a minute. The GAAP and IFRS, they really require the temporal method when your subsidiary is integrated with the home activities, with the home office of the multinational. So the subsidiary is doing much the same type of business. So therefore, the functional currency is going to be the home currency. You need to use the temporal method. What about the current rate method? Remember, the objective here is to reflect the parent's entire investment in the foreign subsidiary. So it's kind of like the foreign subsidiary is an entity on its own. It's not subject to the whims and the whams of the head office. So the head office saying to the subsidiary, you go this way, you go that way. No, the subsidiary is making money on its own. It's sort of like an independent investment. So what do we need to do here? We need to reflect that. We use the current method to reflect that, because that independent investment can in total in one big package can go up in value, can go down in value as the foreign exchange rate changes, appreciates or depreciates. It's not just some of the assets, like the current assets, that go up and down. The fixed assets go up and down also. And this is the difference. This is the different orientation that the current method has. And you are allowed to use the current method if the multinational is treating its subsidiary like an investment. So in this case, all assets and liabilities are translated at the current exchange rate. Equity accounts are translated at the historical exchange rate. Revenues and expenses are translated at the exchange rate in effect at the date of the accounting recognition. You see that? So therefore, we're using a current method, current exchange rates where possible, right throughout the income statement and the balance sheet. So basically, under the current method, we're trying to reflect the total of the exchange rate risk. Furthermore, we've got a translation of retained earnings. We need to think about this because in a minute I'm going to tell you how retained earnings plays a role in the adjustment entry. So let's go through what this means here. Stockholders' equity items are translated at historical exchange rates under both the temporal and current rate methods. So it creates a problem with retained earnings because in many ways retained earnings is a composite of many previous transactions. And traditionally, retained earnings comes from the income statement. So in many ways, retained earnings fits with the way we derive our retained earnings, fits with the current method, because the current method creates a new income and then that becomes your retained earnings. But under the temporal method, the retained earnings is basically the difference between the assets and the liabilities. And then that goes back in the income statement and there's an adjustment entry that is made. We're going to talk about that in a minute. So there are complicating aspects of the temporal method, as you've probably just realized. I keep on telling you that it's very easy to work out the retained earnings under the current rate method because the retained earnings is the new income that is created. Under the temporal method, the retained earnings is not. It is different. It is more complicated for the following reasons. We want to keep track with the temporal method because there are some assets in the balance sheet that need to be tracked at historical rates. The monetary items need to be tracked at current rates. So now you need to keep a record of all the historical exchange rates in your business. You can't just refer to the latest exchange rate anymore under the temporal method. You need to have a full record. So more documentation, more administration. Accountants love this sort of thing, yes. What else is complicated with the temporal method? There's a calculation of cost of goods sold. This is very tricky. Why? Because beginning inventory is going to be at a historical rate. Then you've got purchases during the period. It's going to be an average rate that reflects the nature of the purchases during the period. And then there's ending inventory that needs to reflect the latest exchange rate or a particular exchange rate for that ending inventory. So there are different exchange rates for the different parts of cost of goods sold. Beginning inventory, purchases, and ending inventory. So it becomes a little bit more complicated under the temporal method. You don't have to do that under the current rate method. Next, application of the lower of cost or market rule. We probably won't go into a full detail of an example explaining that. And then fixed assets, depreciation, accumulated depreciation, these are treated differently, and we're going to look at that in an example. So let's have a look at what I'm trying to talk about here. With this translation adjustment, I just want to skip over the previous slide. I didn't explain it very well, but I want to show you a new slide here. Under the current rate method, the remeasurement gain or loss is created in the balance sheet. What do we mean here? Because the income statement naturally creates a new retained earnings because everything in the income statement is adjusted according to an average exchange rate or an ending exchange rate under the current rate. Creates a retained earnings that goes into the balance sheet. And so then you've got your assets, you've got your liabilities, retained earnings, and any difference is the remeasurement gain or loss. Very easy, quite easily done. So the current rate method, we are pushing that adjustment from the income statement, we're pushing it down into the balance sheet. The adjustment happens in the balance sheet. But with the temporal rate method, we are pushing up that adjustment into the income statement. We are creating a new retained earnings in the balance sheet. How do we do that? Well, we check out our assets, we've got our liabilities, we adjust the current assets for the current rate, monetary items for the current rate. We have our new assets, we've got our liabilities, we adjust the current liabilities if we have to for the current rate. We've got our difference, retained earnings. We grab all that retained earnings, okay, and that becomes the difference between assets and liabilities, and that's pushed up into the income statement. And what do we do then? Well, then that retained earnings is compared with the new income under the temporal method, and any difference becomes the remeasurement gain or loss. In other words, the measurement gain or loss under the temporal method is created in the income statement. So let's have a look at a good example. Now, just to summarize the difference between the current rate method and the temporal method, we've got all the assets in the balance sheet. Under the current method, use the current exchange rate, but under the temporal method, only the monetary assets are adjusted according to the current rate. The non-monetary assets, we use historical rates. That's why you have to keep a lot of records. Liabilities, current liabilities at the current rate, long-term debt at the current rate. Everything else in stockholders' equity is at historical rates under both the current method and the temporal method. Okay, so just get that. The current rate method, very easy, but everything is current except for stockholders' equity. So let's have a look at the income statement. Notice, under the current rate method, we have revenues, all the items, cost of goods sold, depreciation, amortization, we use the average exchange rate. But under the temporal method, we're using the average exchange rate for revenues and most expenses. But with cost of goods sold, we are bringing in historical exchange rate, especially beginning inventory, okay? Purchases during the period, and then we've got ending inventory. It's a little bit more complicated with the cost of goods sold. So let's have a look at an example where we can draw these differences out, shall we? We've got temporal and current rate methods compared. We're first going to look at the current rate method, then we're going to look at the temporal method, and then we're going to explain the difference. And let's have a look at a Mexico example. Everyone loves Mexico. Why? Well, it's a US-based textbook, so we've got America. Everyone loves America. And we've got Mexico. Mexico, lots of subsidiaries down there. China is not the only place for cheap labor. Lots of cheap labor in Mexico. Very cheap there. Anyway, so we have a multinational, US multinational. Their subsidiaries in Mexico. Now let's first make some more details available. We have the balance sheet of the Mexico subsidiary that's in pesos, cash, accounts receivable, inventory, fixed assets, and depreciation. Got that? We have accounts payable, long-term debt, capital stock, and retained earnings. Great, so we've got enough for the balance sheet here. Okay, let's go to the income statement. We have sales, 20,000, cost of goods sold, 14,000 pesos. Sales, general administration expenses, 2,500. What about depreciation? $1,000. Interest expense, 500. Income tax expense, 500. Okay, so we're still in this Mexico example, and we want to illustrate the two different translation methods, but we need a bit more information. That is, we need to know what other assumptions we need to make. Number one, there was no beginning inventory, so that's going to simplify our calculation of cost of goods sold under the temporal method. What about inventory? It's carried at cost, was acquired evenly during the last quarter of 2010. So therefore we might use the exchange rate, the average exchange rate, for that last quarter. See, note these bits of information. This is very important. Purchases were made evenly throughout the year, so we might use the exchange rate for the average exchange rate throughout the year. Fixed assets were acquired on January the 1st, and capital stock was sold on January the 1st. Aha, so now let's have a look at the temporal and current rate methods for our Mexico example. So what have we got here? We have a relevant exchange rates, US dollar per Mexican peso. At the beginning of the period, it was 10 cents. At the end of the period, it's 8 cents. So the question is, did the Mexican peso, did it appreciate or depreciate? Ah, you're right. Yes, it depreciated. At the beginning, each Mexican peso could purchase 10 cents in US dollars, but at the end it could only purchase 8 cents, basically depreciated by 20%. That's a huge depreciation in 1 year, but that's a topic for another video. The average during the year was 0.095 cents, and the average for the last quarter was 9 cents. So let me put these down in this yellow bracket. And I think this is very important because as we go from slide to slide, we can bring these dates and the exchange rate with us so we can quickly refer to them. Okay, I've got my pen so we can mark it up now. We're using the current rate method to begin with for our Mexico example. Notice here are our exchange rates. Under the current rate method, what we are doing now is using the average rate for every one of these items. What does that mean? Well, we are multiplying the old income statement, which so for example, sales was 20,000. Okay, so we can draw in 20,000, and the 20,000 will be at 0.095. Okay, 0.095. There you go. That's a nice 9 there. And basically, we're going to do that for every one of these items. We take the old income statement, we just multiply everything by 0.095. What falls out from this calculation is this number here, 142. And this is what's so special about the current rate method, because this is the item that goes across to the balance sheet. Why? Because this is your retained earnings. Yes, you know that, don't you? Yes. This is your new retained earnings, 142. So let's go across to the balance sheet, shall we? Here's our balance sheet. Notice we have brought across retained earnings of 142. So let's go back again. Step 1. This is step 1. We have created a new retained earnings, a new net income in the current rate. Now we bring that across and put it here in the balance sheet. Yes. So what else do we do with the balance sheet? Well, we need to adjust the cash, and we're using the current rate here. We're using 8 cents per peso. So cash becomes 80 cents. This 0.08 affects every one of these items, and also it affects both of the liabilities. So we've basically multiplied the cash, accounts receivable, inventory, fixed assets, accounts payable, long-term debt by 0.08 to get these new amounts. We have not changed the capital stock. That is at the historical rate. Okay, we have also, what else have we do? We've got retained earnings, so that's come from the income. So the only trick here now is this fixed asset. So what do we do here with the fixed asset? Originally we have 8K in fixed asset. Now 8K at 0.08 equals 640, right? So let's write down 640. There's my beautiful writing. Love it. Okay, now we need to take off the depreciation for the period. Now, what is the depreciation for the period? Well, it's $1,000, but it's at the average of 0.095 for the period. So therefore, we take off 95. And then we're left with 5, 4, and 5. So step 2, this is our big step 2. Okay, our big step 2 is this calculation of this part here, this fixed asset. Yes. Okay. All right. Step 1 was the creation of this 142. That was from the income statement. Very, very easy. Everything multiplied by the same rate. But step 2, fixed assets, you needed to treat the depreciation here. This depreciation of $95, that had to be used at this average rate, whereas the 8K in fixed assets had to be created at the current rate. Now, see, you got that there, haven't you? All right. Capital stock is kept at the historical rate. Retained earnings from income. So there we have step 1. We're creating a retained earnings. Step 2. We're creating the fixed assets. Right. This one is at the current rate, 640. The depreciation is the average rate for the period, 0.95. And step 3 is basically this calculation here, and that is the cumulative translation adjustment. Wow. What does this mean, you may ask? Basically, this is the difference between the total of the assets minus the liabilities, capital stock, retained earnings. It's the difference. It's the adjusting difference. Without this, you cannot have a balance sheet. A balance sheet exists because it balances. Yes, you know that. So step 1, create retained earnings. Step 2, we are not applying the final current rate to the depreciation. Why? Because the depreciation occurred during the period. So therefore, we're using the average for the depreciation here. All right, we're using the average. And that's why we get 545. That makes it a little tricky one here. That's the only tricky part here. in the balance sheet. And then 3 is our adjusting entry. 1, 2, and 3. There you have the current rate method. You're done for that. All right. So we want to look at the temporal method now. And this is a little trickier. Now let's see what the exchange rates are again. The peso started off with buying 0.1 US cents at the beginning of the period, but then it went down to 0.08. Notice the average for the whole period is 0.095, and the average for the last quarter is 0.09. Yes, you know that. Okay, so what are we going to do here? Well, this is tricky. Let's first circle the tricky parts. The tricky parts are as follows. As I mentioned earlier, cost of goods sold. We're going to have to pull that out and explain that in a bit more detail. We're going to do that. All right, so just hold your horses. We're going to get to this in a minute. What about sales? Well, sales is going to be at average. All right, so let me just put A for average. All right, what about gross profit? Well, that's just a subtotal. What about sales, goods, general administration expenses? Again, we're using the average. What about depreciation expense? We're using historical here, historical rate. Okay, it was 1,000, so the US dollar equivalent is historical 100. Yes, 0.10 times 1,000 equals 100. Interest expense 48. We're using the average, so we're basically multiplying the peso interest by 0.095 to get 48. There may be just a rounding error here. Interest expense, we're rounding the other way. Income tax expense, we are rounding the other way. And there we have a remeasurement gain. We're going to come back to this one. So this is the other tricky one that we need to consider. Yes. Okay, so we've got cost of goods sold to deal with. We've got remeasurement gain to deal with. Okay, we've got a few things, many moving parts here. But we need to go to the balance sheet before we can work out this remeasurement gain. Okay, so but first of all, before we go to the balance sheet, let's just summarize what we've got. We've got sales at the average rate 0.095. Sales, general administration expense at the average rate 0.095. Depreciation expense, historical rate 0.1. Interest expenses, average rate 0.095. Income tax expense, average rate 0.095. There you go. So that's step one. Step one, we are doing these translations. Okay, step two, we need to look at cost of goods sold, don't we? Yes, so how are we going to do cost of goods sold? Well, this is the tricky part, and this is where we need to, I've got some workings here so we can work this out properly. Okay. What is the here's our cost of goods sold. Beginning inventory is 0. So we don't have to, and that's normally multiplied by the historical cost. So we've got nothing here. Nothing. What about purchases during the period? Purchases were 16.5K. 16,500. What are we going to multiply that by? Well, they occurred during the period. So therefore, we times it by an average. And what do we get? We get 1,567.5. Yes, we got that, haven't we? All right, there's a little dot there. Make sure we get that dot. We don't want to give away more money than we have to. Yes, and then we have closing cost of goods sold. What's the closing inventory? Was 2,500. So let me just put 2.5K here. 2.5. And what are we going to multiply that by? Well, the closing inventory was purchased in the last quarter. So therefore, we're going to use the average for the last quarter. And that's different for the average for the fourth quarter. So that's going to be 0.09. So this one is this is a fourth quarter. Let's just put fourth quarter average. All right. So that's a little bit tricky for this one. Whereas this is the average for the whole year. And so 2.5K times the fourth quarter average, which is how much? It is 0.09. So that gives us what? You know what it gives you. It gives you 225. So what's the difference for cost of goods sold? It comes out to be 1,342.50. Well, 250, we rounded up, and so we've got 1343. So let's just go over this again. Beginning inventory was historical. Purchases during the year is the average rate during the year. Inventory purchase in the last quarter is the average rate in the last quarter. Now, you were told that in the question, so that gave you perfect guidance to use the last quarter average. That gave you 1567.50 here, minus the 225 to give you 1343. So that's the second step, cost of goods sold. Now we want to go to our third step, and that is we need to go to the balance sheet. But remember, there's one thing here, that we've got this net income of 225, and this 225 actually comes from the balance sheet. This is what I was saying earlier. The temporal rate method, you are pushing up the retained earnings from the balance sheet. It comes here, and then the difference is a remeasurement gain that will complete all of the adjusting entries under the temporal method. So let's go to the balance sheet. But here are the two steps we have done so far. We have made adjustments for all of the items except for putting in the last two, that is the adjusting entry and the net income. All right, we've done everything else. Number two, in part of doing everything else, we have done those three separate calculations to get a proper value for the cost of goods sold. Now, number three, we need to go to the balance sheet. And here in the balance sheet is where we make the adjusting entries under the temporal rate. We've got cash, which is going to be at the current rate. You know that, 0.08. What about accounts receivable? You know that at current rate, because it's a monetary item. Monetary items, current rate, same as the current rate method. What about inventory? Inventory, is that going to be 0.09, because the inventory was accumulated in the last quarter of the period, so we're using the average 0.09 here. So this is going to be the fourth quarter. I can draw my Q, fourth quarter average. Yes. What about fixed assets? Remember, under the temporal method, we're using historical, very simple. What about accounts payable? It's monetary, right? So therefore we need to use the current. What about long-term debt? Again, we treat that as monetary, and so that means we use current. Capital stock, again, historical. Interesting. What is left? What about retained earnings? What is the exchange rate for this? There isn't any. This is the tricky part, and this is how the temporal is different from the current rate. The current rate calculated the retained earnings for you. It was the net income under the current adjustments of all of the items in the income statement. But under the temporal method, the retained earnings did not come out of the income statement. The retained earnings is coming out from the difference of all of the assets revalued and all of the liabilities and the capital stock. Two of them revalued at current, one at historical. Therefore, the retained earnings is the difference. And so then let's put that down as step 3, because now we have created this difference, retained earnings, and we can take this 225 and what are we going to do? We're going to put it in here. Yes, we're bringing it back into the income statement. This is what the income should be, which balances everything. So all we're left with is number 4, and that is our remeasurement gain. There you go. There you go. And I apologize for my writing here, but these are the steps that you can take under the current rate method and temporal method. Where the remeasurement gain comes from is different under both methods. Under the current rate method, it's the final difference in the balance sheet. Under the temporal method, it's the final difference in the income statement. That's the big difference here. So what else can we learn from this? Summary. Under the current rate method, all assets and liabilities are translated at the current rate. This results in net asset exposure. It's like treating that subsidiary as an investment. That means all parts of that subsidiary go up and down with the exchange rate. Under the temporal method, only monetary assets and liabilities, the primary ones, are translated at current rate. It results in a net liability exposure. and a net liability exposure and a devaluing foreign currency result in a translation gain, and that gain is normally included in current income. So what do the standards GAAP, IFRS have to say about these two different methods? Well, first of all, whether you use temporal or current, we need to work out what is the functional currency. If the functional currency is going to be the home of the head office, which is in the US, then it's more likely you have to use a temporal rate, especially if the subsidiary is integral to the head office strategy. Okay, there are instances of head offices being located in Canada, they have subsidiaries in the US, and they choose the Canadian dollar to be the functional currency. But often, most calculations are derived for head offices that are operating in the US, that are headquartered in the US. There are a list of indicators that gives you guidance to work out what is the functional currency. I'm going to show you in the next slide. When the functional currency is the US dollar, then the temporal method is required. This is the rule. When the functional currency is the foreign currency, then the current method is required. And so here's some of the guidance notes that we can check to find out whether the functional currency is the foreign currency or the parent's currency. It can be the foreign currency if that subsidiary is so independent. Have a look at that. It's independent in many ways, and that's what all of these points are saying. Whereas here, the subsidiary is interdependent. The subsidiary is part and parcel of the headquarters operations, and that's what these notes are pointing to. So have a look at this. They are the basic differences. The fallback position is you use the temporal method unless you're convinced that the subsidiary is totally independent and you have a lot of evidence to say that it's really treated like an investment. Of course, there are other requirements for hyperinflationary economies where they require those that have 100% inflation or more over a 3-year period. Temporal method is required. Okay, IFRS, what does that IFRS have to say? It uses the functional currency approach developed by FASB. In other words, there's harmonization here. They're sort of on the same page here, which is a good thing, right? We've got to have some agreement some places in the accounting standards. The standard includes a list similar to FASB in terms of guidance for the foreign currency decision. In hyperinflationary economies, again, IFRS tends to follow the GAAP approach. So again, they're in harmony here. There's a little bit more detail here. You can go into that in the textbook. And finally, getting back to what we talked about in the previous week with forward rate contracts and option contracts, if we're going to treat a subsidiary as being totally independent, then it might behoove the multinational to enter into hedging contracts or forward rate agreements, and then that becomes part of the accounting to help offset any translation gain or loss at the end of each reporting period. Keep in mind, there are two main methods: temporal, the current rate method. It's all about translation of a foreign currency of a subsidiary back to the home currency, the functional currency of the head office, in most cases in the US, that most of these examples are derived from. Thank you, and catch you in the classroom. Bye for now.